as long as we're continuing in this direction, gold, which just went over treasuries in global FX reserves, I think it's going to continue. And I think within 1 to 2 years, we're going to get a headline that says gold is now bigger than US dollars all in global FX reserves. China imported 1,300 tons of gold. $22,000 an ounce, China runs a flat trade balance, right? So that's $22,000 is where we got to beat a flat balance. That has very important implications for the dollar were that to happen.
My belief is that because of the size of the on-balance sheet and off-balance sheet liabilities of the U.S. government, relative to the size of the U.S. economy, the purchasing power of the U.S. dollar will decline by 75% over 10 years. If that's true, it is likely, as far as I'm concerned, that the nominal price of gold reflects the deterioration of the purchasing power of the U.S. dollar. That would suggest over 10 years a threefold increase in the price of gold.
In the latest wave of market headlines, gold and silver continue to attract global attention as investors hedge against rising deficits, geopolitical tensions, and accelerating de-dollarization. With central banks increasing bullion purchases and global liquidity tightening, both metals remain in focus as potential safe haven assets. Recent market movements show renewed strength in gold as demand rises across emerging economies, while silver follows closely with volatility but strong industrial backing. In this discussion, financial analyst Luke Gromen explains why he believes gold is still the cheapest asset on the board. He highlights how the metal's role as a neutral reserve asset is strengthening as nations diversify away from U.S. debt. Gromen emphasizes the growing shift in global energy and monetary systems, suggesting that gold's importance will only increase as the world moves toward alternative reserve structures. Let's watch clips from Luke Gromen's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
I continue to think gold is the cheapest asset on the board. I say that because it is still, with this huge move, at 11 or 12% of the market. The market value of U.S. official gold is still 11 or 12% of U.S. foreign held debt outstanding in total. And long-term average is 40%. 1989, when the Berlin Wall came down, it was still 20%. Dollar crisis in 1980, it was 135%. So I think it is still by far the cheapest asset on the board. In terms of why I think it's still, I think, and I said this at the time, we saw that pullback, we saw the VAT and China issue. It's two simple questions for me in terms of gold. Is gold still a buy? A, do I think the United States has made a decision to allow China to build its entire military for it and critical rare earths, all of it, just offshore the rest of it, in order to defend the bond market? And the answer is there's no chance of that happening. Question number two, do I think China and Russia are going to make a Yeltsin-like choice and make themselves economic vassals of the U.S., sell all their gold, replace it with treasuries, and hold 10-year treasuries yielding 3 or 4% when U.S. debt issuance grows 8% CAGR as it has since 2008? And same thing, I think there's 0% chance of that happening. And so as long as we are continuing to try to reshore, the world needs a new reserve asset, because you would have to be an idiot to own, to be reserving as a sovereign, particularly one who's in conflict with the U.S. The long-term treasuries, long-term bonds of the U.S. Treasury, when the U.S. is A, in conflict with you, and B, literally borrowing money to buy commodities. You should just buy commodities or something that better represents a commodity proxy, which is gold. Gold has risen significantly in commodities over the last 3 years, over the last 5, it's tripled in the last 3 years, the gold S&P commodity ratio, Goldman Sachs commodity ratio. It's up more than that over the last 15 years. And so as long as we're continuing in this direction, gold, which just went over treasuries in global FX reserves, I think it's going to continue. And I think within 1 to 2 years, we're going to get a headline that says gold is now bigger than US dollars all in global FX reserves. And that'll be a combination of price, and it'll be a combination of continued tonnage from central banks. And that's going to be, I think, a really interesting moment in time that's going to trigger a lot of cognitive dissonance among sort of, the US dollar uber alles crowd, which is what are we still on a dollar backed system if gold's the biggest reserve asset? And I think, it'll be a dollar centric system, but it'll be gold based, not gold backed, but gold based. But so I still think gold has, a lot of upside on a number of different metrics, whether it's, the the number, that you need to, the balance, China's trade balance, right? So 2024, China ran a $990 billion trade surplus. Everybody says, oh, it's unfair. It's unfair. Well, China imported 1,300 tons of gold. $22,000 an ounce, China runs a flat trade balance, right? So that's $22,000 is where we got to beat a flat balance. That has very important implications for the dollar were that to happen. You look at it relative to commodity markets, it's still, the oil market alone is still 6, 8, 10 times bigger than the gold market in annual physical production terms. So I think, gold is replacing treasuries in global FX reserves. I think people are starting to admit that now after years and years of it being very obvious. But I think it still has a long way to go. To me, this whole stablecoin gambit that we seem to be trying to run as a country, the more and more I look at this, the more the only way it works is if Bitcoin is a much bigger number. And to me, it feels a little bit like we are, sort of not saying the quiet part out loud, which is, yeah, we want stablecoins. We're really trying to stand up Bitcoin as a competing reserve asset to gold, because who's going to hold 0% yielding stable coins at, the Europeans, not really. We can threaten about guaranteeing things, but they're already taking steps, putting capital controls to prevent outflows. Myron yesterday or 2 days ago said, well, we're not targeting the Europeans, not targeting developed markets. We're targeting, emerging markets. Well, great. Like how much money is really in Africa? How much money is really, right? Are they really going to finance our deficits for 3 weeks in bill markets with stable coins? And oh, by the way, it relies on them not turning around and buying Bitcoin with the stable coins, which is what they're going to do with at least part of it. So I think you want to own both. And in terms of the balance, I think some of it depends. For me, I have them probably half and half, and I try to kind of maintain that. But I think some of it depends on your volatility tolerance, and that depends on your profession, number one, in terms of the audience here, and also your age, right? So my kids, I just keep telling them, buy more Bitcoin, have a couple gold coins. I'll give them a couple gold coins for Christmas, whatever, right? Or a gold coin for Christmas. But buy Bitcoin, because I feel like by the time they need that money, that probably they can withstand the volatility. They don't need the money. They're still on the bank of mom and dad mostly, and what have you. Older people, I think you should mostly be gold, because you can't have that volatility. It's much more proven. I think, look, if I was 65, I'd probably have 95% gold, 5% Bitcoin. And you know what? If Bitcoin goes to zero, not that I think that's going to happen, who cares? And if it does what a lot of people think it could do, then hey, great. It's going to be a really nice kicker. And I don't think the success of one is mutually exclusive relative to the other. I think, to my eyes, the East, BRICS, Global South are clearly, gold is the new reserve asset. It's way too small to be used. It's going to get bigger. Bitcoin might be being used in the West. We'll see. But it's a neutral reserve asset for the people, energy tied either way, which I like.
Gold and silver markets continue to react to rising concerns about U.S. fiscal instability and global energy uncertainty. Recent trading sessions show investors turning toward hard assets as fears grow around expanding government balance sheet liabilities and the potential long-term erosion of purchasing power. With commodity markets showing renewed volatility, precious metals remain central to conversations about wealth protection and capital preservation. In this prospect, veteran natural resource investor rickrule explains why America's massive on- and off-balance sheet obligations make some form of financial restructuring, whether inflationary or explicit, almost unavoidable. He argues that this environment strengthens the case for owning real assets, especially precious metals. Rule highlights how markets often hate sectors with strong fundamentals, and he believes this mismatch creates powerful opportunities for disciplined investors. Now let's get into the video.
My belief is that because of the size of the on-balance sheet and off-balance sheet liabilities of the U.S. government, relative to the size of the U.S. economy, that the purchasing power of the U.S. dollar will decline by 75% over 10 years. If that's true, and I believe it is, I'd love to see somebody challenge my arithmetic, it is likely, as far as I'm concerned, that the nominal price of gold reflects the deterioration of the purchasing power of the U.S. dollar. That would suggest over 10 years a threefold increase in the price of gold. Is it going to happen? I don't know. But it's arithmetically logical that it would occur. The second thing is that gold traditionally has done well, reflecting that fear in real interest rates. If you believe in the CPI, you believe that the deterioration of the US dollar is proceeding along at 2.9% a year. The problem is that the CPI is a flawed index. When I look at the basket of goods and services that I consume, the deterioration of the US dollar relative to what I buy, what my household buys, is declining in purchasing power at about 8%. So if you buy the US 10-year paying 4.1 in a currency that's declining by 8, what that means is that you're losing 3.9% a year compounded. There is nothing that could make you more concerned about the maintenance of the purchasing power of the dollar than a guarantee that your savings cost you 4%. Hence, gold does well. If you look at the S&P 500 in the period 2000 to 2025, and your denominator is gold rather than the dollar, the S&P 500 has been in a bear market for 25 years. If your denominator is fraudulent, then you see us in a bull market. I mean, this is really pretty simple arithmetic.
It is.
I have, as an example, I've maintained liquidity in US dollars, but I've saved in gold for 25 years. And when I look at the part of my ledger that's constructed in gold, I'm struck by how cheap things are. Energy's cheap, food is cheap, housing's cheap. What I use as my denominator, the US dollar, things are expensive.
Yeah.
The mining companies have also been trained to use fairly conservative price forecasts. When people's earnings forecasts are based on $2,750 gold and $3,000 gold, and they're selling the stuff for $4,000, there's pretty good earnings surprises. And earnings surprises drive share price escalation. I think there are good as opposed to bad surprises baked in the cake for at least 2 more quarters.
Absolutely. Well, the average gold price, what is it now, 3,800 this quarter or something like that? There's another $200, $300 higher than in Q3?
Yep.
Absolutely. We're on the right track.
Now, what we are seeing is we're beginning to see pretty ugly cost creep. And I suspect what we're beginning to see is payback for prior year's high grading. What happens when you high grade is that you artificially goose earnings in that quarter, depending on how you report, but you also sterilize the ore around what you high graded. So I think part of the cost escalation that we're seeing now is payback for hidden sin, but we'll work through this. I'm not a trader, but it's a matter of public record that about 5 weeks ago, I sold off 25% of my shareholdings in juniors. I didn't do it because I anticipated a pullback. I did it because the market was extremely hot. And I have learned that whatever's easy to do in a market, you should do. When there's all bidders and no offers, you should throw up some offers. When there's all offers and no bidders, you should throw up a bid. Arithmetically, I was able to sell off 25% of my position and pay for 100% of my position, including the capital gains tax. So I sold off 25% of my upside and I eliminated my downside. That's a good trade. I think that gold mining beta does well. I think gold mining alpha does better, but I don't care what I think. This gave me the ability to, by selling off 25% of my upside, eliminate my downside. What's instructive, I think, is what I did with the money. I took half that money and I invested it in a package that included gold itself, Franco-Nevada, Wheaton Precious, and Agnico Eagle. In other words, I traded in alpha and I bought beta. I think the market's going the other way, but that's not what I care about. I care about how it affects my own portfolio. I took the other half of the money and I put it in the oil and gas business. I love, as you know, Kai, I love hate.
Yeah.
I love hate surrounded by good fundamentals. And the market hates oil, so I love it.
In conclusion, both experts point to a financial landscape that is shifting faster than most investors realize. With global confidence in debt-based systems weakening, precious metals appear positioned to play a far larger role in the years ahead. The widening disconnect between policy decisions and long-term economic stability only strengthens that outlook. Rick Rule's focus on structural obligations and Luke Gromen's emphasis on changing global monetary flows highlight the same theme. Resilience belongs to those who prepare early, stay informed, stay positioned, and protect your future. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.